scared. I think the stonks might go down again, and when my portfolio goes down, I poop my pants a little bit, and then I sell all my stocks, and I go buy Tbills, treasury bills, because then I can get a guaranteed rate of return, and there's no risk. Why would you buy stocks when you could just buy Tbills and get 5%?
Welcome back to Strongman Personal Finance, everybody. We got to talk about fallacy, a mistake, a clownish belief that retail investors have. One of them is that treasuries, that's debt issued by the U.S. government, the federal government, the feds, is risk-free. Now, a lot of you clowns were probably buying long-term bonds when interest rates were at 0%, when the Fed's fund rate was at 0%, weren't you? And you know what happened to long-term bonds when interest rates got raised? Even safe government bonds. Guess what? They went down in price massively because interest rates and bond prices are inversely correlated because it's the present value of future cash flows discounted at the market rate. I know, it's pretty complex. But anyway, we got to talk about Tbills. What are Tbills? Tbills are short-term government debt, federal government debt. You can go on Treasury Direct and you can buy Tbills. You can go to a freaking, there's probably 1,000 ETFs out there where you can invest in Tbills. Basically, the U.S. government borrows money, the federal government, the most powerful country in the world that's never defaulted and has a great credit rating and is basically risk-free. They will borrow money and they will pay you interest. You will get paid to lend the federal government money. Now, there's a whole world of options out there, okay? There's, where's it at? There's 3-month treasuries, okay? You just lend the federal government money for 3 months. What's the risk in that? You think the feds are going to default? Oh, the debt ceiling, boo! Yeah, what happened with that? 3 months, you can lend the government money for 2 years and get 4.77%. You could lend the government for money for 10 years and get 3.83%. Or you could lend the government money for 30 years and get 3.93% per year forever into the future for the next 30 years. But you look at this and you say, I see that 3-month Tbills are trading at 5.4%. And the longer the maturity of the bond, so like you basically how long the government is borrowing money from you before they have to pay you back, it seems like they give you less interest. I mean, I guess the 10 and 30 are different. It seems like they're giving you less interest the longer out the bond is. That's really interesting. What's going on here? But just put all your money in 3-month treasury bills. Why would you do anything else? What's the risk? It's 5.4% per year, by the way. Okay? That's one big mistake you clowns make. You think that 5.4% is in 3 months? No. Okay? It's for a year. It's an annual rate. You're not getting 5.4% in 3 months. An annualized rate of 5.4%, yes, but you're not getting it 3 months. Freaking clowns. Anyway, why is this happening? Well, let's think about this very, very carefully. Okay? What do we expect the Federal Reserve is going to do? Whatever they said they're going to do. They're going to raise rates 2 more times. 25 basis points. They're going to raise the federal funds rate, okay? And that's going to drive up, well, that's definitely going to drive up treasury yields, I believe. What's going to happen after that? Let's say inflation cools down because that's why they're raising rates, right? They want to cool down inflation. Oh, guess what? They're going to start lowering rates at some point. I don't know when, but they're going to do it. I guarantee, especially if the economy starts sputtering, they're going to lower interest rates. Watch. And what's going to happen to Tbills? 3-month Tbills. Are you still going to get that 5.4%? No. You know what you're going to get? You're going to get 4.5%. And then it's going to go down. Then you're going to get 3.5%. And then you're going to get 1.5%. As the Fed cuts interest rates in the future, the T-bill rate will go down. There is a risk, and it's called reinvestment risk. There are lots of risks associated with bonds, okay? Let's go look at some of them. Here's some risks, all right? There's a lot of risks getting bonds. Bonds are not risk-free, okay? It's obvious. If you have half a freaking brain or you really study this stuff, you know that. Okay, let's talk about the 9 types of bond risks. The one I'm talking about for T-bills is reinvestment risk. You think you're getting a good deal. You're getting 5.4%. But if you only get like a short-term T-bill for a couple weeks, and then all of a sudden the Fed starts cutting rates, oh, guess what? When you have the money, when the government pays you back and you want to buy another T-bill, rates are lower. That's called reinvestment risk, okay? So you go back, and let's say you want to buy a bond directly from the Treasury. So you go to Treasury Direct, and you buy a bond. If you buy a 30-year Treasury, you're going to get 3.93%. You hold the bond for 30 years, and the Treasury is going to pay you 3.93% for the next 30 years. You've locked that in. You're only locking in 5.4 on a 3-month Treasury bill for 3 months. And when rates go down, which they eventually will, oh, guess what? You're not going to get 5.4. But if you buy this 30-year right now, you will get 3.93% for the next 30. That's not going to change. Now, the bond price will fluctuate, but if you just hold the bond for 30 years, you just collect the interest payments, okay? 3.93%. That's the risk of buying T-bills, okay? And you know what else is going to happen when we buy T-bills? When you buy T-bills, because they're safe and they're paying high interest. And I got my savings in a money market fund or a chunk of it. Why? Because it's my emergency savings, and it's yielding a lot better than my bank. But you can also just put it in a high-yielding FDIC-insured bank as well. What was I saying? At some point, interest rates are going to go down. And stonks are probably going to go up. Okay, because when they cut rates, that's usually a good thing for stocks, okay, in the long run. Cutting rates is generally a bullish thing for stocks in the long run because you're discounting the future cash flows of the stocks at a lower discount rate compared to the risk-free rate, and value stocks go up, basically. So don't think you're a genius because you're buying T-bills. People that are buying 30-year treasuries right now, I'm not saying you have to do this, but they're locking in almost 4% for the next 30 years. You're not locking in 5.4%. This could change very quickly. Look at how much rates went up. Okay, this is during the virus. Okay, you see this gray. This is the recession, I guess, or when the lockdowns happened, right? They cut rates, and the federal funds rate, once they cut it, was 0.08, 0.05. What was the 3-month? 0.14. 0.14. Not too long ago. And then we got inflation because there was a whole clown market. And we see the Fed's fund rate is going up. And so is the 3-year treasury or the 3-month treasury yield. But when rates go down, trust me, interest rates go back to zero, your 3-month treasury, when you buy the next one, you're not going to be getting a lot of money. Okay. That's a piss poor, pissant interest rate right there. At one time, it was below the Fed's fund rate, 0.03. It's insane. Okay? So there's a lot of risks with bonds, and you got to be careful. You can't just say, oh, it's risk-free. Just put all your money in it. Why would I want to buy stocks when they're going down when I can just get a risk-free 5.4%? Because you have to think about the long run, okay? You're not going to get your 5.4% into perpetuity. You can only lock in these lower rates right here. 4.7 for 2 years. 3.83 for 10 years. Wow. That's a crazy return right there. Okay. So that's the risk of T-bills. I mean, like, if you look at the other risks, you have inflation risk. Basically, if you have a fixed coupon bond, but inflation grows faster than the interest rate, you're losing money. Credit risk, that's not really a risk for the government. Basically, just credit risk is the risk that the issuer, the person that's borrowing your money, doesn't pay you back. I wouldn't worry about that with the feds. Interest rate risk, a lot of people learned what that was when interest rates went up, especially with long-term bonds. And, Silicon Valley Bank also learned that as well. Default risk, that's the company going out of business or the government entity. Liquidity risk, having a hard time to sell it. Call risk, sometimes bonds have an embedded call option where the issuer can buy back the bond at a fixed price because maybe rates drop and they want to buy it back so they can issue debt at lower interest rates. Rating risk, credit agencies. Market risk, that's the general overall market, and reinvestment risk, okay? So out of all these, what is your biggest risk with a T-bill? Reinvestment risk, okay? There is a risk. It's not insane. You're not going to lose your money, but holy freaking crap, don't think you're going to be getting 5.4% forever. I think it's a very temporary thing. That's all I'm saying, okay? Let's do some comments, then I'm done. I'm done for the night. Only thing risk-free is real. That's right. Buy the dip. T-bills by E-bills. inflation risk, and interest rate hikes. Default risk. I'm bullish on ticker EBT. Theoretically, it's safer than a bank. Yeah, well, the banks are backed by the federal government. FDIC at least is. The yields, bro, it's risk-free. There's no risk, bro. Like, why would you buy stock? Why would you buy a 30-year? Why would you lock in a 3.83% or 3.93% when you can get 5.4? Yeah, what's the catch? They aren't risk-free, but buying the 10 or 20 really pretty much is if you can wait for the yield curve to uninvert, which always does. If it does not, America dies. America ain't gonna die, boy. We're America. What's healthier? Date? Oh my God. Jeremy bought PayPal options. He didn't buy it. Did he really? Did Jeremy have a mill in Walgreens in the 40s? Did he have $1 million in Walgreens? Oh my God. Doesn't matter. Patreon's booming. Corsair. T-bills are passive income, bro. The interests are free money. It is. I mean, I guess you could say it's passive income. You buy it and they pay you for the 3 months that you borrow, that you lent them the money for. And then, oh, rates dropped. Oh, now your next reinvestment, interest rate's lower. He did. He's always trading in and out and never says anything. Oh, he's a long-term investor. He's a long-term investor. I need cash. I need in the short term. That's slightly followed. Currently, there's nothing wrong with that. Long-term investment. There you go. I like it. Wish everybody did that. He also sold Corsair my Foursquare. Of course he did. Only thing risk-free is doing the opposite of Jeremy. Jeremy's like Ark, a one-hit wonder. That's all it takes. That's all it takes to be a success on YouTube. You could get just obliterated in dozens of investments. But you buy one Tesla and you're just a genius. You're not buying random stuff. No, you're just a genius. Okay, that's it. T-bills are definitely better. Well, okay, I would agree with that. Yes. T-bills are a good short-term place until a better idea. I mean, honestly, if you're an index fund investor and you have a long time horizon, I would just throw it in the index. If somebody gave me $100,000 right now, I'm not joking. I would throw it all. I'd put it all in BT. I'd max out my rest of my Roth 401k, and then maybe I'd save a little bit for the Roth IRAs next year, maybe for the 401ks, but it would basically all go in the market. Because it's long-term investing, bro. All right, that's a little T-bill education for you, okay? Government bonds. Risk-free, bro. Just high interest, bro. Yeah, not for long. Talk to you later. Cheers.